Welcome back, everyone. This is the second discussion video for Chapter 7. In this video, we're going to calculate some activity rates for our activity cost pools in our ABC system. We'll also get those costs assigned to products and customers and come up with some customer and product margins. So first up here was learning objective 3, which was to compute activity rates for those cost pools. So let's extend our Baxter battery example from the previous video and in your notes there. And let's assume that the ABC team determines that in Baxter battery, we'll have the following activity totals for each activity cost pool per year. 10,000 customer orders, 4,000 design changes, 800,000 machine hours of production, and 2,000 customers served. So now we can come up with activity rates. And the way we do that is fundamentally the same as how we calculated predetermined overhead rates in our traditional costing systems. We take the total estimated cost in our activity cost pool now and divide that by the total estimated activity based on our activity measures, number of orders, number of changes, and so on. And that's our activity rate. So customer orders first there. We had total cost assigned to that in our first stage allocation of $4,520,000. So we'll take that and divide it by the 10,000 orders we expect to fill across all customers in the upcoming year. And there's our activity rate of $452 per order. Design changes was the next activity cost pool. We'll take total cost that had been assigned there of $3,040,000. divided by the 4,000 expected design changes we'd have during the year, and there's an activity rate of $760 per change. Order size cost pool had $5,200,000 assigned to it. We'll divide that by the 800,000 expected machine hours across production, and there's a rate of $6.50 per machine hour. And then finally, customer relations, $3,080,000 assigned to that cost pool. We'll divide that by the 2,000 customers we expect to be serving here, and there's $1,540 per customer. And just quick note, our other activity cost pool, remember that was all the org sustaining cost. Those things are not getting assigned to products or customers under any circumstance. So we didn't have the activity measure for it at all, and we don't have an activity rate then by which to assign those costs. So to recap kind of where we're at here so far in our ABC system, as we discussed earlier, we're still tracing any direct cost to our cost objects. So any direct materials, direct labor, any direct selling costs, things like shipping. Again, tracing those directly to the appropriate cost object, whether that's the product, customer, or whatever. Then all those overhead costs, both manufacturing and non-manufacturing overhead costs under this ABC definition. Via a first stage allocation, we dumped that or assigned it to our individual activity cost pools. And we had 5, only 4 of which were getting assigned to products or customers. The other was the org sustaining bucket that does not get assigned. Then via our second stage allocations through our activity rates, we would assign those costs to our products, to our customers, or whatever other cost object of interest we had. So let's do that now in learning objective 4, assign cost to a cost object using this second stage allocation. And the nice thing is there that this draws a pretty close parallel to our traditional costing systems as well. So we're going to assign these costs using our activity rates, similar to the way we used our predetermined overhead rates in those traditional costing systems, to our individual products or customers based on the actual activity they used or consumed throughout the period. So let's assume a couple more things about Baxter here. Let's say for their Sure Start, the kind of standard model battery they had, that it required no new design resources this year. 800,000 of those things were ordered with 4,000 separate orders from customers. Each one takes 36 minutes of machine time for a total of 480,000 machine hours. The long life, that deluxe model, let's say that it assumed or required some new design resources. We'll talk about how much in a bit here. 400,000 batteries were ordered with 6,000 separate orders. 4,000 custom designs were prepared. There's our design resources. And each long life requires 48 minutes of machine time for a total of 320,000 machine hours throughout the year. So here we're going to assign overhead to those two products then. So let's look at the Sure Start here first. Again, that had a whole bunch of order activity. I didn't have any design changes. So the customer order activity cost pool, which had a rate of $452 per order, we'll multiply that times the 4,000 customer orders that were placed for the Sure Start, and there's a total cost assigned of $1,808,000. Again, no design changes needed there, so we're not assigning any costs from that activity cost pool. And then order size had an activity rate of $650 per machine hour. We'll multiply that by the 480,000 machine hours that were required to produce all those Sure Start batteries. And there's total cost assigned of $3,120,000. So if we sum all those costs up, that means we're assigning $4,928,000 to the Sure Start product. Then we'll do the same thing for the long life. It had 6,000 customer orders, so we'll multiply the 6,000 orders times the $452 per order activity rate for that cost pool. And there's costs assigned of $2,712,000. The long life did require some design changes, so 4,000 changes there times the activity rate of 760 per change, and there's a total cost of $3,040,000. And then order size had that rate of $650 per machine hour. Multiply that by the 320,000 machine hours needed to produce all the long lives, and there's our cost assigned of $2,080,000. So when we add that all up, we get $7,832,000. Also worth noting here that if we add up the cost we assign to the long life and to the Sure Start, we would not reach that total overhead cost of $22 million that the company had as a whole, because we had that other cost pool, the org sustaining costs, that aren't getting assigned to any product. And that was over $9 million. And it's not uncommon in practice to see these org sustaining costs that are unassignable to products be a pretty significant portion of total overhead cost. Just the nature of doing a lot of business. So that would reconcile to our $22 million company-wide overhead cost though, if we added the two individual products there, plus that org sustaining bucket. Now let's say Baxter, instead of trying to determine potential profitability at a product level, wanted to do it at a customer level. They wanted to see, well, what types of customers are really most profitable for us? Which ones should we continue trying to serve and focus on and drum up additional business in that area? And which ones might we consider kind of cutting loose or shifting focus on? So let's assume for a second Acme Auto Parts here placed a total of 12 orders throughout the year for Baxter. 4 orders for long lives required a design change. So in total, let's say we had 8 orders for 60 Sure Starts per order and 4 orders for 50 long lives per order. Machine hour wise, the 480 Sure Starts took 288 machine hours. The 200 long lives required 160 machine hours. And again, we had the design change for the 4 orders for long lives. So to assign cost to this customer, we're going to do that assignment in essentially the same way as we would to the individual products, by taking the activity rate for each activity cost pool that's appropriate times the actual activity consumed by the customer. So first up, we had that customer order activity cost pool that had the rate of $452 per order. So we'll multiply that by the 12 orders that Acme placed throughout the year, and there's our total cost of $5,424. Now, those 4 orders for the long lives did take some design changes. So the rate there was $760 per change. Multiply that by the 4 changes needed, and there's total cost of $3,040. Our order size cost pool had the rate of $650 per machine hour. So we'll multiply that by the 448 machine hours across all that customer's orders. Total of $2,912. And then we had the customer relations cost pool. And I'll just note real quick here, we weren't assigning that when we were looking at the product as the cost object or the object of interest, because the product is not a customer, right? If we're not serving them with any kind of customer relations activity. But here we're talking about a customer, so we do include that. That customer relations activity cost pool had an activity rate of of $1,540, multiply that by just technically the one customer that we're talking about here, Acme Auto Parts, and there's our cost of $1,540. So that would be total cost assigned to this customer throughout this period of $12,916. We can use that then in theory to figure out how profitable we are in serving this customer. Quick question then, true or false? The assignment of cost to cost objects under ABC is mechanically the same as the assignment of overhead cost to cost objects in our traditional costing systems. That is, both involve the use of 1, a rate based on beginning of period estimates, and 2, actual activity during the period to make this assignment. Is that true or false? Pause here and then come back for the solution. That is true. In our traditional costing systems, our job order costing and our process costing systems, we had those predetermined overhead rates that were based on estimates at the beginning of the period, and then we applied overhead using the actual activity throughout the period. Same idea here in ABC, only now we've got more rates. We've got those activity rates, which are based on estimates, and we're factoring those by the actual activity or consumption of these resources by products or customers or whatever the cost object is throughout the period. So a bit, or at least some parallels there in terms of how these things operate, something that I think is helpful to keep in mind. All right, so now learning objective 5 is to use our ABC to compute product and customer margins. So we already talked about assigning cost to those cost objects, and now we'll just take it to the finish here and figure out what those margins might be. So let's start with product margins. The first step there is to gather each product's sales and direct cost information. So for Baxter, let's assume sales for the Sure Starts there were $31.3 million. For the Long Lives, $18.7 million. And then we had some direct costs. Direct materials, $9 million and $6 million for the two products respectively. Direct labor, $7 million and $5 million respectively. And then some shipping, direct selling cost, $2 million and $1 million respectively. So again, these things we don't have to allocate via any kind of activity rate. We're just tracing them directly to the individual products. Next up, we would just want to incorporate all of our cost assignments from our ABC system. So bringing those forward at the bottom here from our previous calculations. Customer orders for both, the design changes for the Long Lives, and then the order size activity cost pool data for both the Sure Start and Long Life as well. And then we're ready to come up with a product margin. So the Sure Start there had sales of $31.3 million. Got all the direct costs deducted from that, as well as all of our costs assigned via our ABC system. That left us with a product margin for the Sure Starts of $8,372,000. For the Long Lives, the sales of $18.7 million, minus those direct materials, labor, and shipping costs, as well as the cost assigned via the ABC system, left it with a product margin in the negative, right, in the red. So a loss of $1,132,000. So all things equal, we'd say, well, if our ABC system represents an accurate depiction of the activities within our production process, if our ABC team has done a good job in defining these activities, what goes into those activity cost pools, and all the costs associated with them, then our Long Lives aren't working out really well, right? They're consuming more resources than they're kind of generating in terms of an offsetting sales or revenue. Okay, all else equal, we'd say, hey, we should probably be focusing on the Sure Starts and not doing these longer life batteries that take more resources, take more customization in a lot of cases, and so on and so forth. We can also reconcile the individual product margin with the company's overall net income. So if we add together at the top here the product margin from the Sure Start and the Long Lives, we get $7,240,000. If we deduct from that all of the costs that we had not assigned to products then, so that was the customer relations activity cost pool, as well as the other bucket, all those org sustaining costs, we'd have that same net operating loss we showed way back when in video 1 of $2 million for the company as a whole. I always want to make sure we can reconcile those numbers back. Now our customer margin calculation operates about the same way. So we were using the Acme Auto Parts customer earlier for that example. Let's continue that. Let's assume that Acme, all the orders they placed with Baxter here, generated sales of $29,200. And then we had direct costs of all the stuff they ordered there, materials $7,500, labor $6,700, and then shipping $1,700. And we're setting up a similar situation here with Acme as we were looking at from the product level, where now we want to incorporate all of those costs assigned from the ABC system. And we calculated those earlier. So it's the customer order, activity cost, pool costs, product design, order size, and then that customer relations piece. And then we'll finish that out by doing the little mini profit and loss customer margin calculation here. So sales of $29,200 minus all the direct costs of servicing Acme, minus all those costs assigned via the ABC system, leaves us with a customer margin of $384. So all things equal, we'd say, well, we're not losing money servicing Acme here based on what they order, but we're not exactly striking it rich. The resources that are consumed by the products they're ordering and us servicing this particular customer are pretty darn close to what we generate in sales from servicing them. And that also doesn't take into account that at some point we have to cover all those org sustaining costs, right? All those things that we're not assigning to individual products or customers. Now I did want to look at what I'd included in the notes there, a quick comparison to our traditional costing systems. So again, thinking back to our job order costing and our process costing, if we were coming up with product margins under those systems, we'd start in about the same place. We'd put together all the direct sales and then direct manufacturing cost information for the two products. So I've repeated that here for the Sure Starts and the Long Lives. Note that we would not include the direct selling costs. Those would not be treated as product costs under our traditional costing systems. And then let's assume we're using a plant-wide overhead rate at Baxter instead of any kind of departmental rates or anything like that. We would have taken the total manufacturing overhead, so just the overhead costs that are in that manufacturing categorization, so indirect wages, factory equipment depreciation, factory utilities, and then a factory building lease, total of $14 million. And we would have divided it by some measure of volume, probably machine hours, given that Baxter seemed to be pretty automated. So $14 million divided by the total estimated machine hours across both those products in the year that we looked at earlier, 800,000, would have given a plant-wide overhead rate of $17.50 per machine hour. Then we would have assigned overhead to the individual products using that rate. So $17.50 times, in the case of the Sure Start, 480,000 expected machine hours for a total of 8,400,000. For the Long Lives, 320,000 machine hours, so a total overhead allocated of 5,600,000. Again, we're just accounting for that total of 14 million in overhead that we estimated at the beginning of the year. Then our margins would have looked a little different, right? The Sure Start, sales of 31,300,000 minus the direct materials, the direct labor, and now this allocated or assigned overhead using the plant-wide rate would have left it with a margin of 6,900,000. The Long Lives would have had sales of 18,700,000 still, minus their direct materials, direct labor, and assigned overhead for a product margin of 2,100,000. So a very different picture being painted here using our traditional costing system. Now in the case of the Long Lives, some of the information we were given kind of gave us some pointers there about this potentially happening. The Long Lives, if you'll recall, needed a bunch of design changes. They were consuming a lot of different resources that the Sure Start was not consuming, or at least at the same rates. So under our traditional costing system, we may have been miscosting and mispricing that product, given that it consumed a lot more resources than we were accounting for. We can also reconcile the product margins here to our overall company-wide net loss, same as we would kind of do before. Total product margin across the two products in this scenario is 9 million, minus all those selling and admin expenses that we weren't assigning to products in any way of 11 million, and there's our same net loss of 2 million. So at least in theory, if our ABC team, came up with some good activity cost pool that accurately describe how overhead resources are consumed within our production processes, then we may have a more clear picture about which product uses more resources, and that should help us focus on selling the thing that's most profitable. In this case, that's supposed to be the Sure Start battery there. And then here's a quick little comparison there. The product, just showing the difference in product margins between our traditional costing system and the ABC system. Again, the big swing, if you will, shifted costs from the Sure Start to the Long Life under the ABC system, resulting in a very different picture in potential profitability. So we'd say that all things equal, the traditional costing system had overcosted the Sure Start and reported a lower product margin for that product, while it was undercosting the Long Lives and reporting a higher product margin than is true for that product. Now, a few things to think about in terms of why those are different. Our traditional costing allocates all manufacturing overhead to products. ABC, though, if you recall, only assigns manufacturing overhead costs consumed by products to those products, meaning all those things like the org sustaining costs don't get assigned to any products or any customers if those are the cost object instead. In addition, our traditional costing allocates all those overhead costs using the big volume related allocation base. In the case of Baxter, that was the machine hours. ABC, though, uses some non-volume related allocation bases. Things like number of customer orders, number of design changes. They're transaction drivers, but they're not based on volume of products, I think is the key distinction there. And then our traditional costing does disregard those selling and admin expenses because they're assumed to be period expenses. Under ABC, we want to make sure any direct costs from those categories do get assigned to individual products or customers. Now, your book did have a little bit of a sidebar or kind of addendum to some of these things that I wanted to mention just briefly. It talked about ABM, activity-based management. That is used in connection or conjunction with ABC to identify areas that would benefit from potential process improvements by focusing on ways to basically increase efficiency, right? Decrease processing time, eliminate waste, reduce rework of things that come out defunct or defective, and so on and so forth. ABC does generally require a shift in incentives, as we hinted at earlier, to things that align with managers' personal incentives, but also to group-based plans, hinging on some type of cooperation. And that does fit with this notion that our activity cost pools and our activities themselves do often cross functional bounds. That's why we had those sort of cross-functional teams. And I point out real quick here that there's a nice study, kind of a seminal study in ABC by Andrea Drake and some colleagues from 1999 that I've placed in our Canvas site under Files in the research folder if you're interested. They conduct a little experiment to test some of these things in an abstract setting. Also worth pointing out on a related note that our activity rates can provide some clues concerning where there's potential waste and the opportunity for improvement. And by that, we're meaning at least we can eyeball those things and think about the resources needed to support these activities and whether our activity rates seem reasonable in that regard. Another way we can use that information or ABC information more generally to make improvements is through benchmarking. So if we have any kind of cost information from like standards of performance achieved by other organizations, or some kind of consulting firm that has information about aggregate standards of performance across many organizations, we can use our activity rates, our cost pools, and our ultimate ABC cost information to benchmark against those things to see in what areas are we running up costs more than the competition, or more than the standard, or more than the average. Another quick note on ABC here, as I mentioned earlier, it is fairly popular in practice, but worth pointing out that companies can't use it for external reporting on average because it doesn't conform to GAAP, generally accepted accounting principles. So for any publicly traded company that has to produce public financial statements, they're not going to be able to use ABC to cost products within those financial statements. So it might be difficult for them to implement ABC internally if they're sort of trying to keep track of two separate books or two separate sets of cost information. And it's also worth noting that via the audit process, auditors may be a little more suspect of some of these subjective allocation processes that go into an ABC system based on interviews with employees or observation of operations or any of those types of things. So it does open up some more potential there for some struggle. And then just to close out here, there are some limitations of ABC to be aware of. It certainly does take substantial resources to implement and maintain. So there is some risk involved in trying to do it for sure. There may be some resistance to unfamiliar numbers and reports from management. As we talked about earlier, this ABC system really needs top management support. We need to educate managers on why it's better for them. We need to tie performance measures to this cost information as well to make sure everything aligns appropriately. Oftentimes there is a desire to fully allocate all cost of products, and it can get companies into a little bit of trouble if they start to sort of over-define these activity cost pools and all these different activity drivers. Similar to the second point, there's the potential for misinterpretation of some unfamiliar numbers or cost information. But again, that just fits with this idea that there has to be extensive sort of training and familiarization to make sure everyone's kind of bought into this. And then as we mentioned, it doesn't conform to GAAP. So if we are a publicly traded company, we're going to need two costing systems for external reporting that is GAAP compliant. So the potential cost that goes into maintaining two sets of books and everything that goes with that, and it may limit the usefulness or at least the cost effectiveness of using an ABC system. So that concludes the second discussion video here for Chapter 7. Be sure to revisit anything you need to and then move on to the practice problem video. See you next time.